Hi everyone! So today's video is a bit different because this time we are not looking at one company. I want to focus on a macro topic, energy. With the current conflict around Iran, energy is back at the center of the discussion. So I want to compare Japan, China, the US and the EU to see which region really has the strongest energy position today. Before comparing the different regions, I think we first need to look at what has already happened in the Gulf. And the scale is already huge. As this chart shows, oil production in the Gulf countries fell from an average of 26.9 million barrels per day in February to 15.3 million barrels per day on March 2022. So that is a loss of 11.6 million barrels per day. Based on the IEA's early 2026 estimate of global oil supply at 106.6 million barrels per day, that is roughly 11% of world supply. And in oil, 11% is not a small shock. This is a market where short-term supply and demand are both very inelastic. So even a supply loss that may not look catastrophic in percentage terms can still create a very large move in prices. And the more recent Kepler update from early April points in the same direction, with around 11 million barrels per day of crude production still estimated to be offline several weeks into the conflict. OPEC Plus did announce a small output increase of around 206,000 barrels per day, but relative to what has already been lost, that is almost nothing. And the real issue now is not just quotas, it is infrastructure. Iran said it still needed 1 to 2 months to restore most of its damaged refining and distribution system. But there is also a second risk behind that. Some shut-in wells and reservoirs can become harder to restart if production remains halted for too long, especially in more complex fields or enhanced recovery projects. So the problem is not only lost output today, it is also the risk of weaker productive capacity later. Qatar is another example. Qatar Energy said they attacked damaged 2 LNG trains and 1 GTL facility, knocking out about 12.8 million tons per year of LNG capacity, or roughly 17% of the country's LNG export capacity. The company CEO said the 2 damaged LNG trains could be offline for 3 to 5 years, while the GTL facility could take up to a year to repair. Maybe those timelines turn out to be too pessimistic. Reuters later reported that some LNG trains elsewhere in the system had already restarted. But even if the final repair time ends up shorter, the broader point doesn't change. Once LNG infrastructure is physically damaged, rebuilding it is complex and takes time. Saudi Arabia, for its part, has restored its east-west pipeline to full capacity of 7 million barrels per day, allowing part of its oil exports to bypass Hormuz through Yanbu on the Red Sea. That clearly helps, but it doesn't solve the core problem, because a large part of the regional supply shock is still there. Another point that really matters here is that the paper market is giving a much calmer signal than the physical market. At the time I'm recording this, Brent and WTI futures no longer look as extreme as they did a few days ago. Hopes of renewed talks have pushed Brent back to around $95 per barrel and WTI to around $91. but that calmer signal is mostly coming from the paper market. The physical market is telling a very different story. In Europe, prompt physical crude has still been trading close to $149 per barrel, and dated Brent remains far above nearby futures. And the same tension is visible in refined products. Jet fuel is still near $200 per barrel, diesel around $170, and US wholesale jet fuel has already moved to roughly $4.85 per gallon in key markets. So the message here is quite simple. Futures have cooled, but the physical side of the market is still extremely tight. That is why I thought it was worth to stepping back and looking at the structure of each major region. And before going further, one quick point on the data. I tried to compile as much relevant information as possible on both the energy mix and the cost of the main energy sources for each region. But in practice, it is very hard to get perfectly homogeneous numbers at the same date and with the same methodology for China, the US, the EU, and Japan all at once. So what I did was cross-check different sources and harmonize the numbers as much as possible. That is why some figures are from 2024 and others from 2025. So this is not something to read to the last decimal point. The goal is simply to build a solid macro comparison of the four major regions. And with that in mind, I think the best way to do it is to go region by region, starting with China. Let's start with China. The key point here is simple. Coal is still at the center of China's primary energy mix, and most of it is domestic. In 2024, China produced about 4,666 billion tons of coal and imported about 542.7 million tons. So roughly 90% of the coal used in the system still came from inside the country. Imports matter, but they are not the backbone. Oil is much more exposed. Crude imports accounted for about 74% of apparent oil consumption in 2024, so only about a quarter was covered internally. Gas sits in between. China produced 246.4 BCM of natural gas in 2024, and foreign gas dependence was around 40.9%. Then you have non-fossil energy, which is mostly domestic on generation side, since hydro, wind, solar and nuclear power are all produced inside China. So overall, China still looks roughly 3/4 self-supplied in primary energy terms, about 77% of this mix. And that is one of the main reasons why it starts from a structurally strong energy position. And this becomes even more important when we move to electricity, because more and more of the economy is being electrified. Here again, China looks strong. The power mix is still dominated by thermal generation, which in practice mainly means coal, while gas plays a much smaller role. So if you combine that with the previous chart, the conclusion is quite clear. China is still close to being largely self-sufficient on the power side. Coal remains the backbone, gas is less important in the mix, and hydro, wind, solar and nuclear generation are all produced domestically. So China's electricity system still rests to a large extent on domestic resources. Now, if we move to the European Union, the picture is very different. Non-fossil energy already represents a large share of the system, while coal now plays only a limited role in the primary energy mix. That reflects years of policy aimed at reducing coal use and relying more on renewables, electricity, and in some countries, nuclear power. But the weak point is obvious: oil and gas. Oil remains overwhelmingly imported, with around 94.9% of demand covered by import in 2023. Gas is also highly import dependent, with around 90% of demand covered by imports. Overall, the EU's energy import dependency rate stood at 57% in 2024. So even if the mix looks cleaner, the European Union still relies heavily on the outside world for a large part of its energy needs. And if we now move to electricity, the picture looks better at first glance. In 2024, renewables made up 47.5% of EU gross electricity consumption and nuclear another 23.3%, while coal fell below 10%. So fossil fuels are no longer dominant in the power mix. That is where the European strategy becomes visible. Less coal, less fossil generation, and much more wind and solar. But the system still needs dispatchable power when there is no wind or sun. And in practice, gas-fired power plants still play that balancing role in many countries. There is also another weakness. Europe didn't build the full industrial chain behind that transition. Solar is the clearest example. China accounted for 98% of extra EU solar panel imports in 2024. Wind is less extreme because Europe still has a domestic industry, but the broader dependence remains. And on gas, the dependence changed more than it disappeared. After 2022, Russian pipeline gas collapsed as a source for Europe, and the gap was replaced mainly by LNG from the United States and more pipeline gas from Norway. So Europe reduced one form of dependence, but created another: less dependence on Russian gas and more dependence on imported LNG and external cleantech supply chains. Now let's move to Japan. Here, fossil energy is still a very large part of the system, with oil alone representing 40.3% of the primary energy mix on this chart. Coal and gas are also still significant, so the country remains heavily exposed to fossil fuels overall. And the problem is simple. Japan produces very little of those resources itself. Oil is almost entirely imported, gas is almost entirely imported, and coal is also mostly imported. The domestic part of the mix comes mainly from non-fossil sources, such as hydro, solar, wind, and the share of nuclear generation that has restarted. So the result is straightforward. Japan's energy self-sufficiency rate was only 15.3% in 2023. And on the electricity side, the picture doesn't improve much. Fossil fuels still represent 65.1% of the generation mix, so even the power system remains heavily tied to coal, gas, and oil. Nuclear and renewables are there, but still not at a scale large enough to really rebalance the system. So when fossil energy prices move up, Japan is exposed twice, through the broader primary energy mix and through the electricity system itself. In a high oil and gas environment, Japan is one of the most vulnerable major regions. Finally, let's look at the United States. At first glance, the mix is still very fossil heavy, with 38% oil, 36% gas, and 8% coal. But the real difference with Europe or Japan is that the US is a net exporter of energy. In 2024, exports exceeded imports for total energy, and imports represented only about 17% of domestic energy supply, the lowest share in nearly 40 years. So even if oil and gas still dominate the mix, the US is not structurally dependent on the outside world for its energy base. And on the electricity side, the picture is very similar. Fossil fuels still represent 58% of the generation mix, while nuclear is 18%, hydro 6%, and non-hydro renewables 18%. So the US power system is still largely built on thermal generation. But again, that doesn't create the same fragility as in Europe or Japan, because the country has its own fossil resource base and remains energy self-sufficient overall. Renewables are part of a mix, but not because the US has no alternative. With its domestic gas resources, the country could rely much more on gas-fired power if it wanted to. Now we can move to costs. This chart needs one warning first. These are plant-level generation costs. For coal, gas, nuclear, and hydro, that already gives a useful first read. But for solar and wind, it doesn't reflect the real cost of the system, because it excludes backup capacity, balancing, curtailment, storage, and part of the grid. So for a rough shortcut in this video, I think it is fair to multiply the plant level cost of wind and solar by roughly 3. Not because that multiplier is exact in every case, but because it gives a better idea of what these sources really cost once they become a meaningful part of a system. Once you read the chart like that, the broad ranking becomes easier to understand. China is the cheapest region on most sources. That is especially clear on solar and onshore wind, but China also remains very competitive on coal, hydro, and nuclear. The United States is the clear low-cost case for gas, which fits with what we saw earlier on domestic supply. Europe is expensive on fossil generation, and coal is probably the clearest example, largely because of weaker fuel economics and carbon costs built into the system. Japan looks expensive on almost everything linked to imported fuels or costly infrastructure. Offshore wind is a good example. In Japan, the issue is structural. Projects move more quickly into deeper water, which means fewer easy fixed bottom sites and a much larger role for floating offshore wind, which is simply more expensive. And since offshore wind is already a capital-intensive technology, that makes Japan one of the least favorable major markets for it. And this is the chart that brings everything together. What I did here is simple. I took the power mix of each region, and for wind and solar, I applied a rough 3x multiplier to better reflect system costs. And once you do that, the ranking becomes very clear. China comes out at 67.7 USD per megawatt hour, the United States at 97, Japan at 154.7, and the European Union at 178.9. So the gap is huge. The US is already around 40% more expensive than China, Japan is more than twice as expensive, and the EU is even higher. And I think the conclusion is quite clear. China has a real structural advantage on electricity costs, which helps explain why it can stay so competitive industrially. The US is also in a solid position. Japan and the European Union are in a very different situation, with a much higher electricity cost base from the start. And Europe looks especially weak because it combines very high power costs with strong dependence on imported energy, in an energy shock that hurts fast. We also need to look at stocks, because the energy mix alone doesn't tell you how long each region can absorb a shock. Europe looks decent on paper for crude oil because member states are required to hold emergency stocks equal to around 3 months of cover. But the weak point is refined products. Europe is much more vulnerable on diesel, gas oil, and especially jet fuel. Japan is different. It has by far the biggest visible oil buffer in this comparison, with reserves covering roughly 7 months. But its LNG inventories are much thinner. The US has a smaller visible oil buffer in months of consumption, but that matters less because the country is net exporter of energy. China is the least transparent case, but it still seems to have several months of crude cover. And for coal, the main protection is not just stocks. It's the fact that China still produces almost 90% of the coal it uses. The data we looked at were basically pre-war. So the real question now is what changes if oil and gas stay higher from here? For the United States in aggregate, it doesn't really change the picture that much. Of course, that doesn't mean everybody wins. Oil-producing states like Texas benefit, workers and companies linked to the energy sector benefit, and part of the domestic energy complex makes more money. But on the other side, households and businesses in other parts of the country still pay more at the pump and more for energy. So there are winners and losers inside the country. But if you look at the US in consolidated terms, this kind of energy shocks is broadly neutral. For China, the main transmission channel is still oil. But oil represents only 18.2% of the primary energy mix on the chart. And China enters this shock from a relatively strong position overall because coal remains dominant and mostly domestic. Gas matters too, but China is not in the same situation as Europe or Japan. Part of its gas supply is domestic, and part comes through pipelines from Russia, Central Asia, and Myanmar, which already reduces its dependence on seaborne imports. So yes, China can still be affected by higher oil and gas prices. But as we saw earlier, China already had the lowest energy production cost among the 4 major regions before this shock. In other words, China entered this environment with an existing cost advantage. That doesn't make it immune, but it does mean the impact is likely to remain more limited than in the other large import-dependent regions. The two obvious losers are Japan and the European Union. Japan is the simpler case. The country still depends heavily on imported fossil fuels in both the primary mix and the electricity mix, so a structurally higher oil and gas environment is a direct problem. But Japan at least enters this period with higher stocks than the EU, which gives it a bit more short-term protection. Europe is the more complicated case, and probably the worst one. This conflict is another energy shock for the EU after the Russia-Ukraine war. Europe is now heavily dependent on the United States for gas supply, and the likely political response will be to push even harder on the energy transition. Maybe that also means more nuclear in the long run, but honestly, I don't see a real acceleration there for now. It looks more like political communication than a concrete industrial plan. And even if Europe started building new nuclear plants today, it will still take about 10 years before the first ones came online. So the central scenario is probably more solar and more wind. But as we saw earlier in this video, those are also the energy sources that have pushed Europe toward a much higher electricity cost base. So in the end, Europe will probably keep increasing the cost of producing electricity. And to me, that is still a very bad choice. Yes, you can say it reduces energy vulnerability to some extent, but in the end, it still pushes up the cost of producing electricity, even though Europe already has the highest electricity cost base among the 4 regions we looked at earlier. And another thing that bothers me is that this strategy is also driven by political and ecological beliefs, while the global reality looks very different. As you can see on this chart, the Earth keeps consuming more and more energy, and renewables mostly add new supply rather than really replacing fossil fuels. So my central case is still that energy prices remain above the pre-war range for at least the next 6 to 9 months, even if diplomacy improves from here. The latest news is better than a few days ago, but even in that scenario, the system doesn't return to normal overnight. Damaged infrastructure needs time to recover, insurance costs are likely to stay higher than before, and many countries will probably want to rebuild and then hold larger strategic stocks than before. All of that can keep oil prices structurally higher. Gas is a bit different though. The medium-term picture looks less tight because a large wave of new LNG supply is expected over the next few years, especially from North America. So the loss of part of Qatar's export capacity is serious, but probably less structurally bullish for gas than the oil disruption is for crude, especially if US LNG continues to ramp up and fills part of the gap. So today we looked at the energy side of each major region, and since energy is one of the main cost factors for the industry of a country or a region, in the next video I will go one step further and look at the broader industrial environment of each of these regions. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe and share.